Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the put-call ratio was at a decade's high, and millennials who just started trading got a harsh lesson. Publisher of the Leibovit VR newsletters, Mark Leibovit, gives us his view on what's driving the markets. Lunar and solar cycles appear to be playing a role. He also mentions what areas of investment could benefit from the social unrest in the U.S. Author of The Money Bubble, John Rubino from dollarcollapse.com, fills us in on silver shortages and how central banks are cluing in on the importance of gold, and he has some ideas on how to deal with financially stormy times. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
It's nice to be back, and this was one of those big weeks we got used to, but this time it was back in the direction that we were doing in February and mid-March.
Well, before we went on air, you said be careful what you wish for, because some people were saying to you, we could use a little correction. I think we got a little more than that, didn't we?
Yeah, I don't think people are expecting, that you would get a 5 to 7% correction within a day or two, or in the case of the financials, I mean, you're talking about double-digit breaks off the highs on the XLF. So it's, when you get the extremes that we've had in the last few weeks, and in particular, things like the put-call ratio in the last week, up at extremes we haven't seen in decades, the number of new call option positions put on in the last couple of weeks was literally double previous highs. The people that are out there trading for no commission in some of these firms that have offered that in the last few months, and with everybody stuck home at COVID, the day traders have just been thinking this was a one-way street, and like many of us who have been around for a while, we said to ourselves, deja vu, this is dot-com mania all over again.
You also said a lot of islands were created. Can you talk about that?
Yeah, people look for gaps in markets when they're running on the upside or the downside, and they'd like to see them coming back and being filled. And then you consequently come back and gap over that same price level. And it doesn't matter whether it's in a single day or in some cases, it could take upwards of a couple of weeks. But in this case, we had most of the indices gapped up, spent 4 days on the upside, and then on Thursday gapped down badly. So this leaves behind an island. You see that in the Dow, it's in the S&P, the NASDAQ 100, the Russell. They've all got this, and some of the ETFs like the XLE, the energy ETF has got one of those as well. And, knowing me, I go back and look at the historicals on these things. We've got somewhere, like on the SPDR, the SPY, we've got just about 20 of these islands in the last, since the beginning of the 1990s when they started the ETF. And about half a dozen of those end up with really extended moves to the downside. The rest of them are just anywhere from 2 to maybe 4 day corrections and then start back up again. And we've got some pretty important parameters that we'll be watching in the next week. We bounced on Friday off that bad break on Thursday, but we're going to need to see follow through by the middle of next week on the upside, or we've got another leg to come on the downside. And from our seasonal work, we've been looking for a correction, not only just in presidential years, but typically in the seasonality for a mid-June through an August low. And, it looks as though we're setting up for that. We've got some good price levels below us in terms of targets. So going to be watching for, as I say, whether there's any better bounce into the early part of next week. If not, you're probably looking at another leg of equal, or like maybe half of the magnitude that we've just seen, and maybe at the most the same as that to the downside.
What's going on with gold?
The gold scenario has been that once you had those gold and crude oil lows in March, April, that gold would have difficulty on the upside breaking out for the next 3 months. And, we are now 2 months into this consolidation in gold. I think they still got a very good chance of going down, testing the 200-day moving average, which is going to be around 1,600, maybe a shade under. If we can do that in the next month or so, that would just be classic as a buying opportunity. And with it going nowhere right now, with all the volatility we've had in these other markets, and in particular the break that we had this week, you would have thought that the safe haven items might have done better. So I'm still of the mindset that we're going significantly higher over time, but that there will be a better buying opportunity than what we're looking at right now. The upside number to keep an eye on is 1815. We need to see it break out not just above the old high, but through the 1800s to say that it's a breakout. In the meantime, wait for a better low.
Oil, is it going to continue to go up?
No, our target in the oil was that it was going to retrace into that $37 to $40 range as a minimal, and an optimum up to 42. We've done that. The ETF and the anticipation there is that we will break back into the mid to low 30s at least. So there's still some room on the downside. As far as the ETF is concerned, on the XLE, that one we were looking for a 38% retracement rally of the whole move from last year's high. So looking for a big retracement rally. That was around 44.5. It spent a day and a half above that, and we're now back down under 40, so it's 10% below what we had as an upside target. And I wouldn't be in a rush to be buying into that one as of yet. We'll be looking for, we need an oversold RSI reading on crude oil so that we can then look at stepping into the XLE. But that will probably come about as a pretty good trade this summer.
Has the Canadian dollar been surprisingly strong?
It was surprisingly into the middle of the week when it broke through that 72 range. It had a very good run, and we tacked on another 2.5 cents above that. We did get back to that big consolidation area that we had July through December of last year. We also got a sequential nine consecutive days with closing above 4 days earlier. That happened into the middle of the week, and it happened actually at the same time that the U.S. dollar index was creating a sequential 9 buy on the bottom. So the Canadian, it backed off at the tail end of the week, and that naturally happened with crude oil. It had been able to participate in the tail end of that crude oil run. We'll see what it does from here, but I think that the high that we put in this week will probably be looked at as a pretty important cap for a number of months now.
Ross, thank you so much for chatting with us.
It was all good to be with you as always, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at Charts by Ross. Coming up, Mark Leibovit next on This Week in Money.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was the #1 U.S. stock market timer in the January 2020 edition of Timer Digest. He's speaking to us from Arizona. Welcome back to the show, Mark.
Thanks for having me back.
For our listeners, you have a special offer.
We sure do. It's a 50% offer for any of our newsletter products. When you go to vrtrader.com, you'll see the full screen of newsletters, Canner Report, the Metals Resource Letter, our Trading Ace service, our Platinum service, our Market Timing service, and so forth. And if you hit the buy button on any one of those products and you fill in a little promo code box with the promo code 2020 half off, just as it sounds, 2020 HALFOFF, you get 50% off. So give it a shot if you like what you hear.
Mark, can you tell us about your annual forecast model, what it shows, and how and why it was created?
Well, the forecast model is something I'm pretty proud of. We started that way back in 1987. It was just sort of a little bit of a fluke. You know, people keep asking technical analysts like myself. I'm also a cyclical analyst, but I became more of a cyclical analyst later. What do you think the market's going to do in the future? And if you're a technician, as a general statement, you really don't have any long-term forecast. You can speculate about stuff. You can look at some long-term cycles. You have to get into more seasonality and cyclical patterns, 4-year cycles and all that kind of stuff. So other people even use 40-year cycles now, and it's tough to make money with stuff like that, particularly if you're more short-term oriented. So we threw together this forecast model. And a big influence for that, it's a long story, but I'm going to tell it anyway. Back in the early 1970s, the first book I picked up on the stock market, and it's not really a book about the stock market, but it's called The Stock Trader's Almanac, and many of your listeners might be familiar with it. It was published by Yale Hirsch, and his son Jeff Hirsch still runs the company. Yale is, I think, in his 90s. He's been doing this for a long time. And it basically is just as its name says. It's an almanac. It's interesting, you know, seasonal patterns in the market. It doesn't tell you when to grow wheat and corn and stuff like that, but it'll tell you, for example, that, you know, the day before, the day after U.S. Thanksgiving, the market might be up. It'll talk about the Santa Claus rally. It'll talk about his famous tool was as January goes, so goes the year. The first 5 days of January are a early warning for the whole year as well. It's very interesting stuff. So this influenced me and got me interested in the markets. And again, it's the first book I picked up about the stock market. And you just flip through it and you see all these anecdotal pieces of information, which is something you don't even hear about on in the financial press or on television or anything like that. And they don't sit around and tell you. They may have picked up some of the stuff. But, you know, you generally don't get all the details that you get in that almanac. So I think that was early 1970s. So then I got into the business, and I'm doing a lot of cool stuff. And in the 1987 edition, I think it was like 15 years later, Yale Hirsch, the creator of the almanac, dedicates his 1987 book to me and 3 other market technicians and calls us the new prognosticators. So you can imagine what an honor that was for me. Here's a kid who knew nothing about the stock market in the early 70s, reads a book, you know, gets influence into the market, actually starts publishing a letter, gets hired by a brokerage firm in Chicago as a floor trader on the Chicago Board Options Exchange and all this cool stuff. And then the guy's book that influenced him is dedicated to, you know, that person, myself in this instance, so many years later. So it was a great personal honor to me. And the forecast model that you asked a question about is influenced to a great degree by patterns that are in that book. So I threw together the 87 edition. Of course, this is many years after I read the book, and the one I threw together sort of called the crash in 1987. And I remember January of that year, we wrote some commentary and said, watch out for that nasty step in October. I think that was the word I used, nasty step. And sure enough, the market crashed. In fact, a month before that, I was on the Louis Rukeyser Wall Street Week television program in Owings Mills, Maryland. I was one of the 10 elves on his program. And that was also a whole other story we can get into, a great personal honor. And I warned that watch out for October, and it was based on the forecast model. So in all the years since, not every year is perfect. I'm not saying it's perfect, but it has in many instances given a roadmap. And if you looked at last year's forecast, it almost perfectly mirrored the move in the market. So if the listeners want to go to vrtrader.com, they can buy the forecast model. It's there for the rest of the year, plus covers a few other markets as well. And that current model, was warning me the beginning of this year to watch out for a low in March, a mid-March low, and sure enough, that happened. So as a result of that, we were able to call the low late in March. Others have as well, but, we had predicted that, in January when we put our model together, and that's pretty much the story, and the rally that's come since as a result of the call of that model.
Cyclically, are we in a time frame for a market peak, and if so, to what extent?
Well, yes, we are. That's the long and short answer. We saw evidence of that yesterday. Basically, when a bird roosts somewhere, it rests there, and the old saying, chickens have come home to roost, is normally used to mean that bad things that someone has done in the past come back to haunt them, and that's what happened to the stock market on Thursday. Way overdone, negative divergences in the market, NASDAQ into new highs, other indexes not going into new highs, big gaps on the chart that are still unfulfilled, overwhelming enthusiasm for the stock market, and then you have the seasonal pattern of sell may go away, and plus the fact it's a presidential election year in the U.S., and there tends to be some volatility in the summer ahead of that. So, really to answer your question, we definitely were in the time frame, and it doesn't mean the market's going to go straight down. It could just be choppy into the fall, big swings both directions. Well, what I would think a little bit more of a negative bias, considering how far we've come up. But you got to trade individual stocks. There's always going to be exceptions, and that pretty much answers the question. We were looking for a top, and I think we should have experienced a top. It looked like one. A lot of technicians are probably talking about it, but there was an island reversal pattern on the charts, and for those who are listening to this probably don't know what the heck I'm talking about, but it's a little chart pattern, and if you gap down out of that little chart pattern, and there's a big gap on the charts, and it's accompanied by heavy volume, which we saw in trading on Thursday, that's generally a negative, and often creates a meaningful short-term top in the market. Not necessarily the end of the bull market, though some instances it could be. So it was a negative pattern, but we came down too far too fast, and we saw the market rebound on Friday today. But the negative pattern is still there, and frankly, I'd be very surprised if we're going to go back right through those highs so quick. So with the Federal Reserve out there and the U.S. Treasury and all the foreign banks pumping money like crazy into the market to support the market, anything is possible in this day and age. After we've been through this pandemic, and after we've been through all this nonsense, anything is possible. So I'm not betting on that, but that certainly could happen. But for right now, I'm leaning more to the cautious approach between now and the fall.
Where are we in the lunar cycles and the seasonal cycles that affect the markets?
Very, very interesting stuff. People think I'm a little crazy because I talk about stuff like that. Well, I'm crazy all the way to the bank, so let them worry about how you use this stuff and not use this stuff. But we did have a lunar, we do track the lunar cycles, and in one of my previous interviews, I went over this in some detail, but I'll cover it again, and if we get cut off, I guess we could always pick up on it at another point. But I was a floor trader on the Chicago Board Options Exchange, as I mentioned many years ago. And a friend of mine down there, an acquaintance at the time, was a financial astrologer. Now, there's a lot of financial astrologers out there, some very big names, many of which you've seen on CNBC and other networks over the years. I always felt just about every analyst on the street was a closet astrologer. They wouldn't admit it, but they certainly would listen to these guys because some of them have made some extraordinary calls in the market, and whether that you believe in astrology or not, that's irrelevant. But anyway, this guy comes up to me and tells me, and I don't want to mention names, but basically at noon the market's going to change direction. If it's up, it's going to sell off big. If it's down at that moment in time, it's going to do just the opposite. So precisely at noon, the market, I remember, did tremendous reversal. It was up and it sold off sharply. And I asked him about, well, how'd you do that? And he referred to some lunar cycle that he was referring to at the time. Now, this is not necessarily astrology, as it could be, but it could also be, geocosmic science and other things as well. So I became very intrigued by that. And then Ian McAvity is a Canadian who produced a newsletter called Deliberations. I think he was out of Toronto. He passed away a few years ago. He was an acquaintance of mine. And he was on the Louis Rukeyser show back, I think, in the early 1970s. And I think it was 72 or 74, somewhere in that time frame. They didn't have him back since, but he spent the whole interview discussing the lunar cycle as it relates to the moon. And he made a whole point about how gold and the lunar cycle are tied together, and for some reason that didn't sit well with Mr. Rukeyser, and they didn't have him back. They probably thought that was too crazy of a subject. But that also intrigued me, because that said, here's a noted analyst, and he had a terrific reputation as a market analyst, that he would bring that to your attention. So over the years, I'm sort of a closet lunar person. I put little pictures in my newsletter once in a while, and what I do is I track all the the quarter of the full moon, the new moon, all this all this fun stuff, and I put it on the charts, and you'll see incredible incredible correlations between the overlap of one of the dates and the movement in the stock market. So as I'm talking to you here, I'm trying to pull it up on my screen so I have the exact dates here for you. So, for example, June 5th, we had a full moon. Now, that was within 1 day of the high. And generally, that's sort of funny because that happens, all right? And today, June 12th, is a third quarter moon. And what happened? The market rallies after a big sell-off yesterday. The new moon is coming up on the 20th of the month, so you've got to watch within 1 day of that. And then you got another first quarter on the 28th. So when I see the market into a high, it doesn't have to be a record high, but a rally high point, particularly if it's rallying for a few days or you're within a day of a lunar point, you got to pay attention to it, particularly if your technical indicators are showing, an overbought reading or a divergence, as was the case. So essentially what I'm saying is between the full moon and the divergences that we saw, the big break that we saw in the market on Thursday was no surprise. And it all sort of fit together, and it has for me for many years. And, I look at a bunch of other stuff, too. I'm not here to teach everybody all the techniques and stuff that I do, but, it's sort of fun things. It shows that there are powers out there that are well beyond our understanding. We think everything is necessarily related to human emotions, reason, and so forth, but it could be, influences from the moon or from the planets or from the Earth itself. And why? We're at 98% water, and I think the moon controls the tides on the Earth. And if you don't think we're affected by that, I think you're a little crazy not to believe that. So, we're all affected by our environment, and the markets, as I've seen over the years, have. And could be short-term events, or it could be bigger ones, but definitely, something worth playing with. I hope I sort of answered your question there, Jim. Got off on a little bit of a tangent.
We'll have more with Mark Leibovit when This Week in Money returns.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit. Mark, can we see new market highs this year, and at what levels?
Well, we already saw new highs in the NASDAQ, and if you had asked me on March 23rd when the market bottomed, and we called for a low in that time frame, and we did get bullish down there that we were going to see new highs, particularly in such a short time frame, I would have thought you were crazy. It usually takes more time than that, and of course we've broken just about every rule. We didn't see it in the S&P and the Dow and the total stock market index or the mid-cap index or the Russell 2000 or other, but we did see it in the NASDAQ, and that's because if we had the big players, the big guns there, like Amazon and Apple Computer and Netflix and Microsoft and the whole little Facebook, that whole group of funny stocks that everybody seems to want to own, love, and pay any kind of price for. Tesla, of course, is another one which hit a new all-time high. I think it was yesterday. I think 1,020 share. The stock, they were giving it away for about $350 a share in March, so it almost tripled. In any event, we've already seen the new highs, and there are a lot of analysts out there predicting new highs, and the way they're printing money, anything is possible. A lot has to depend, I think, too, on whether Donald Trump gets reelected. I'd be very surprised if a Democrat gets reelected and the market goes to new highs. But, I've been doing this for enough years that it's not what you believe, it's what the market decides it wants to do, and there's bull and bear markets no matter who's in the White House. So anything is possible, but I would think a greater chance to see the Dow and the S&P into new highs if Trump gets reelected. And, who knows, you might even see it before that time. So, again, what's the reason? Well, very few places for your money, and the market's doing well. A lot of European investment coming in, foreign investment into the U.S. So, basically, where are you going to put your money? In bonds? Getting no money, no interest, no return in the bond market. And a lot of people love gold, but not enough necessarily to put a lot of substantial assets into it. And the market seems to be the only place. So my answer to your question is, we've seen it already. We probably will see new highs, and we'll try to time it the best way we can. And whether we stay up there in the stratosphere and come crashing down again, time will tell, and we'll do our best to try to gauge that. But I would suspect the next couple of years you're going to see a lot of volatility, much as we've seen here. And but I think the long-term picture is bullish for the market. Just pull up a 100-year chart or 200-year chart of the markets from the 1780s when the first markets start trading. I think there's some records that go that far back, and you see a big zigzag pattern, but it's always at a 45-degree angle from left to right, and it's just inflation in force, and just human nature and greed, and growing business and improving technology. So, the Dow will probably be 40 to 60,000. Where is it now? At 25,000, probably in the next 5 to 10 years. So for young kids and long-term investors, you put it away, you're going to be fine. If you're more of a timer, you wait for the pullbacks.
What other forces may be at work behind the crash, recovery, and future market movements?
Well, I know there's political forces at work. We can see what's going on right now in the streets in the U.S., and you're probably experiencing it some up in Canada. Events in Seattle, for example, events are bizarre, as you know. Armed radicals have taken over 6 blocks downtown with unbelievable de facto blessing of the city officials. So this really has nothing to do with any legitimate protest. It's really violent gang power grabbed, encouraged by at least that mayor's appalling weakness, in my opinion. And the proponents for defunding the police claim to be seeking justice and equality for minority communities. And I guess that's the right goal, but the approach risks moving both Canada and the U.S. in the opposite direction. Economic opportunity requires peace and security and effective law enforcement. So the riots, the disorder are not not healthy. The stock market, at some point could be affected by that. It was affected at least on Thursday. We came back a little bit today, Friday. That's one thing. Of course, we have the Democrats in the United States who are more seditionists than politicians, looking to unseat a duly elected president and not doing their job in Congress and spending all their time and their joint forces by also, I use the word sedition because I really think it is, the financial press and the regular press in the United States and maybe in other places as well. And it's criminal activity. And unfortunately, those forces are at work, and they're doing what they can, and it's not legal or proper, in my opinion. It's not an expression of free speech when every day you're out there trying to throw somebody out of office when there's no legitimate reason for it to occur. So those are other forces that are in effect as well. And getting way out there on a tangent, forgetting the lunar cycles, and we didn't discuss the seasonality patterns, which I meant to mention a few moments ago. You've got the summer solstice coming up on June 20th, and in fact, I did a whole workshop yesterday. We talked about this. The change of directions in the markets often, not all the time, occur around the solstices. So we saw, if you pay attention to the vernal equinox, which is in mid-March, that was around the market bottom. We've got the summer solstice, June 20th, and we saw the market top out here in the last few days, so it doesn't have to happen the exact day, but we're in the time frame for summer. And you've got the winter solstice, in the mid-December, and you've got your fall equinox too. So these are times where you often see markets change direction. So these are powerful forces out there that could also be influencing it. There's an interesting video that I posted on my website, Jim, last night. Someone sent it to me. It looks real to me. You'd have to I guess you have to be a subscriber to see it, but somebody's driving somewhere in northern Alaska, and they're shooting a video, and it shows 3 suns setting, not one sun, but 3 suns. So either it's some optical illusion or something really unusual going on there, but there's been some unusual stuff going on in the geocosmic world, and I'm paying a lot of attention to that. In the recent weeks, there was talk about 2 comets possibly getting close enough to each other to create an EMP event here on the Earth, which did not happen. There's been a lot of stuff that we're not being told. There is a website that you can go to. It's a NASA site where you can see a lot of the activity with asteroids and a lot of cool stuff that's going on out there. We do have some near misses, by the way. And one of the original things that I had talked about when this whole pandemic regarding the Wuhan virus started is my initial feeling was that we're trying to be distracted by some other thing that's happening out there besides necessarily a political event and so forth. And now we got the riots in the streets, and now the virus seems to be coming back in certain places around the country and the world. And it seems like our attention is being directed inwardly, not outwardly. Instead of looking up to the heavens and looking up to see what might else be going on in the galaxy, so to speak, we're looking only internally here. And to me, I guess I've been around too long. I'm too much of a cynic. I've seen manipulation in the markets. I see what happens when that occurs, and my gut feeling is there's something else going on, and I don't have the answer for you. We may never know the answer, but I think there's something we're being distracted from that might actually scare the heck out of people if I really said what I wanted to say. But we'll talk about that another time.
Mark, where are we in the gold markets?
A little nervous about gold here. I'm a big picture bull. I think the gold market can and will go higher. The question is, will it be a big bull trap when it finally gets to new record highs in the U.S. based in U.S. dollars? I know it's already into new highs in other currencies. My work saying it's pretty much third and fourth quarter is probably the greater chance for a move to new highs. And right here, we actually went short and exited some gold shares, short via the inverse ETF for a little trade and sold some of our gold stocks, thinking that we can buy back at a cheaper price. So a little cautious, very short term, but later in the year, and I think you'll see a big up move, and hopefully we'll be able to repurchase sometime during the summer.
What's going on with oil?
Hit one of our targets. We're looking for the $39, $40 level. It did. My gut feeling is to go a lot higher later, but I think it pretty much exhausted its technical bounce, much as we saw in the stock market here. Oil and stocks seem to track together in more instances than you would remember, and I think it may have just been a coincident move. We had a nice technical bounce. Remember that crude oil got down to like $35 a barrel minus, and then rallied all the way up near 40. So that was a $75 rally in theory in crude oil. So my gut feeling is, big picture probably okay. Short term, we probably hit a top, and not excited about crude oil here as much as we were when we saw the big sell-off and a trading opportunity to the long side.
What are your favorite sectors or trades?
I think we need to talk about individual stocks, and that's more in the newsletter. But as I mentioned in the previous recording, I'm into the gun stocks, for example. I think we got all the civil unrest. You have to look at some names, and then you can look up the names. I'm mentioning specific stocks that are in that business. Defense stocks related to personal defense and so forth. Unfortunately, we're going to probably see more civil unrest in the months and years ahead. So those, you have to, like anything else, you have to try to buy them on pullbacks. Like uranium, I think uranium is cheap compared to where it has been, and in fact, it really hasn't participated to the upside. So looking at some uranium stocks. We did mention gold here on a pullback. I think there's still more of a play there. The cannabis stocks, which had a big top last April, pulled back, and we're trying to trade those from what appears to be a reasonable bottom. So just off the top of my head, those are some groups that come to mind. And one more would be infrastructure stocks having to do with concrete and steel and so forth, with regard to rebuilding the infrastructure here in the U.S., thinking about what companies that are in the metal, concrete business and so forth, infrastructure business, that would benefit from that type of funding.
And Mark, before we go, can you repeat your special offer for our listeners?
Sure. It's 50% off, and the code is 2020 half off, 2020 half off, 2020 HALFOFF. We have raised our prices, by the way, for those of you who may have checked our pricing in recent days, and so the 2020 half off is from higher prices than before, and we think we deserve the higher prices, so you still get a discount, but on some new pricing. So thank you, and look forward to you guys signing up.
Mark, thank you so much for being on This Week in Money.
Anytime. Thank you.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. Coming up, John Rubino, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
John, what's the latest on silver shortages?
Well, silver has been an interesting market over the last few months because there really hasn't been enough physical silver to meet the demand. So that if you wanted to, say, buy some maple leaves or silver eagles or something like that, you couldn't just go to a dealer or pull up a gold website online and buy them. And at the same time that there was long wait time, the premiums were really high. So you might have to pay $4 or $5 over spot to get an ounce of silver. Now, what that means is that demand is strong, supply is either normal or less than normal, and that's a good thing for the price of silver going forward. Historically, when there's a shortage of silver, the price ends up rising in the subsequent bull market. And the last couple of times that happened in a big way, silver went to $50 an ounce, U.S. Right now it's, $18? So that's a nice run if we go back there. And there's no reason to think it won't continue after $50 this time around because the numbers are so much more horrendous. We are a soon-to-be bankrupt global financial system, which means the governments of the world have no choice but to try to inflate their way out of this, which is great for precious metals. So I think silver is going to be one of those things that people of the future, when they look back at today's prices, wish they'd bought a lot more and done so aggressively.
John, on television, I'm seeing ads asking for huge premiums to buy silver coins, $20 perhaps above their face value, plus $5 shipping and handling. Should people be very aware or beware of these kind of offers?
Well, you should always be wary in the precious metals market because, it's not unique in having a lot of scam artists, but it does have a lot of scam artists. So you need to be very careful. There's always a premium over the spot that you pay when you buy physical silver coins, for instance. And what you want to do is shop around and find the smallest premium possible, because, at various places in that market, there are outrageously large premiums that people who don't know any better sometimes pay. So you don't want to be one of those people, so you need to shop around. The premiums you just mentioned are way too high, even though there are high premiums out there now, but, $5 or $6 is a high premium. $20 is a fraudulent premium. So don't pay that, and when you see something like that, stay away from those people forever. Never go back to them again.
Now, of course, I remember the 70s when the Hunt brothers tried to corner the silver market and drive up prices. Could the same thing happen again?
Jim, do you really remember the 70s? You're older than I thought you were. But I actually do remember the 70s. And yeah, the same thing could happen again. Although, the Hunt brothers was kind of a unique situation in which there were actually people trying to manipulate the market. And, a precious metals bull market doesn't require any kind of manipulation for it to go on for a long time and take prices much higher. And I think that's more likely the way it worked this time, where just market forces, not some, group of rich guys trying to run some kind of a scam in the market, but just the fact that there's not enough silver to satisfy a growing demand, and that sends prices higher, is what is at work. And I think that's already happening, but it's got a long, long, long way to go because we're screwing up on an absolutely biblical scale financially. I think the U.S. is going to run a deficit approaching 10% of GDP this year because of the coronavirus and because of our general fiscal mismanagement here. And that's dumping a ton of debt on top of an already wildly over-leveraged system. And historically, the only way out of something like that is either a 1930s-style crash where all that debt gets wiped out because people default, or a hyperinflation, or at least rising inflation, where you make your currency less valuable, and that makes it easier to pay back the debts that were taken on back when the currency was strong. We'll see that. The governments of the world have no choice but to engineer something like that going forward, and that's paradise for precious metals. So I think that, with some corrections along the way, we will see a bull market that continues for the next 3 to 5 or 6 years, and that takes prices much, much higher from here.
Now, we've seen China and Russia snapping up all the physical gold they could handle over the last 5 or 6 years. What's that going to do to the price of gold going forward?
Well, Russia and China and India have long histories of monetary chaos, and they've they've learned over the centuries to appreciate a form of money like gold that can't be inflated away and can't be created out of thin air. So in times of stress, they gravitate towards precious metals, and they're all buying up gold and or silver pretty aggressively. Now contrast that with the West, where we're dumping all our gold onto the market. You know, the central banks of the West have been selling gold for the past, well, actually lately they're buyers. I have to give them credit for that. But over the previous decade, prior to say 3 years ago, they were net sellers of gold. And that's where a lot of the gold that's been accumulated by the Asian countries has come from. Now you've got those guys still buying, but you've also got the Western central banks in there buying. So you've got central banks as a whole being fairly strong net buyers of gold. And, you know, gold and silver are related. When I talk about gold, I'm actually talking about silver as well, because they tend to move in the same direction over long periods of time. And, you know, it's not clear why Russia and China are buying gold specifically. In other words, what's their plan? It could be that they just see the monetary chaos that's on the horizon that you and I are talking about, and want to be on the right side of that by owning things that will hold value. And it could be that they intend at some point in the future to make their currencies backed by gold, and in that way make their currencies global reserve currencies, and take away some of the unique power that the U.S. has with the dollar being the world's global reserve currency. That allows us to bully other countries and to generally get away with stuff that a normal country shouldn't get away with. Russia and China would love some of that power, so it's completely possible that somewhere down the road, their plans call for backing their currencies with gold and stealing a lot of the dollar's thunder. So either way, if they're just investing or if they're playing geopolitical games, they're doing the right thing in this environment by loading up on gold.
Could we ever see major countries, not just Argentina or Chile, default, but the U.S., Canada, Britain, and say, that's it, we're not going to pay off anything, we're starting from zero? Could they do that?
Yeah. Well, I mean, we don't have much choice because we can't pay off what we owe. So somehow, some way, we have to default. You can default in lots of different ways, but the most common and the politically easiest way is inflation. You just make your currency a little less valuable each year, so you give your creditors back the same number of dollars that you contracted for, but those dollars are less valuable, so you sort of defaulted, right? You're giving them back less value than they gave you. And over time, the amount of depreciation, in other words, the percentage of value that a currency can bleed away in a process like that can be substantial. A lot of currencies in inflationary periods have lost half or more of their value, and quite a few of them have lost way more than half. If you Google list of hyperinflations, you'll get a long list of countries who have gone through currency crises like I'm predicting for the big fiat currencies, and it'll show you the percentage inflation at the peak of the inflationary cycle, and those are big numbers. They have years in which their currency was dropping at like a 90% rate. It's just something that would be terrified for a holder of that currency. So, yes, we can do that. We kind of have to do that. And the only question is, what form will the default take? And that depends on decisions of, people who are under stress, who don't really understand the world that they're in, making snap decisions. And so we can't know exactly what they'll do because, by definition, people like that aren't going to behave necessarily rationally or wisely. But it's a very safe bet that we're going to default some way, somehow. And the people who trust the governments by holding the currency of those governments will be the ones who are hurt when that default comes.
Where are we in the gold-silver cycle?
You mean the gold-silver ratio cycle?
Yes, I'm sorry. Well, yes.
the relationship of the price of gold to the price of silver. Right now we're at an extreme reading of gold being more valuable than silver. In other words, a high number for the gold-silver ratio. It's something like 100 right now. In past cycles, 80 was a big number. In other words, it took 80 ounces of silver to buy 1 ounce of gold, and that was considered a lot, so that meant silver was very cheap relative to gold. And then following that peak, silver outperformed gold for a few years until the gold-silver ratio got down into the 30, 40, 50 range. Since we're at 100 now, which is way higher than the historical norm for a peak, it's reasonable to assume that over the next few years, silver will dramatically outperform gold. There's no way to know the specific timing in all of this, but the general trend over the next several years ought to be good for silver relative to gold, although usually the way this works is that gold continues to go up in a cycle where silver is rising faster than gold, because the reason silver is rising faster than gold is that the conditions are such that precious metals in general are coming back into favor. And silver is a thinly traded market, so when lots of money is flowing into precious metals, most of it goes to gold, but enough of it goes to silver to push silver up dramatically. And that's what we should see going forward.
John, I remember when we first started doing our interviews a few years ago, gold was considered nothing more than a pretty rock. Have attitudes changed a lot since then?
Yeah, gold is coming back into style big time. You mentioned the other central banks that were buying gold. So that's official approval right there, right? They're signaling that they believe that gold is a monetary asset that is of value. In other words, that's worth swapping your dollars and euros and yen for. And the demand for physical gold and silver on the part of investors is also rising. So yeah, they're coming back into style, and the reason for that is that they're gaining respect among people who are educating themselves about financial history and realizing that fiat currencies always go back to their intrinsic value, which is zero. And gold and silver always hold their purchasing power over long periods of time. So you want to be in the latter and not the former when something like this is happening.
Can you imagine the situation that we're in right now? And I think we talked about this just before Christmas, where you would have a number of crises all at once. The repo crisis hit. You have the pandemic. Now riots. How do you protect yourself when you find yourself in such a topsy-turvy world?
Well, life works that way. Whether you're an individual or a family or a corporation or a country, when you have one problem, you can devote a lot of energy and attention to that problem and have a good chance of solving it. But when you have multiple problems, it becomes overwhelming because, frequently the solution to one problem makes the other problem worse. And then you've got a real mess on your hands. And that's where we are now. Last year in the U.S., the repo market, which is a very important financial market in which banks lend money to each other, just froze up. And the Fed had to come in and ramp up QE again, which is an emergency financial measure. So before the pandemic even hit, we had a mid-range financial crisis going that we were dealing with. And we were sort of dealing with it. We seem to have that under control. Then global pandemic hits. And we've got this lockdown where in order to stop the pandemic from spreading, we have to make everybody stay home for a while, which basically just shut down the global economy, which makes everything much harder to deal with, because all of a sudden we're now, if the banks were worried about lending to each other before, now they're really worried about that. And then everybody else is piling up debt. Countries are running massive deficits and everything to try to get through this pandemic. And before the pandemic even ends, we have yet another video in the U.S. of white cops killing a black guy. And finally, so we have riots because of that. But those riots were magnified by the frustration of everybody having been locked in their homes, basically being, under house arrest for 2 or 3 months, and it was most difficult and most frustrating and most terrifying for people in cities who have jobs that require them to go out into the world. So all of a sudden they couldn't do that. They couldn't work. They couldn't make any money. The government gave them a little bit of relief money, but not nearly enough to feed their families. And so you had, this incredibly frustrated group of people, which maybe is half the population, who live in urban areas and who aren't able to work. And then you've got this ongoing racial stuff where, it's amazing how many videos have come out in the last couple of years, in which sort of the same thing is happening, where, someone is getting killed just because of the way they look. So it's not at all surprising that we had civil unrest for the past couple of weeks. And that is destabilizing. So we've got, a financial crisis, and then a health crisis, and then civil unrest, and it's all snowballing into what might be a very difficult second half of the year, and we're not done. That's the thing. We're going to try and run an election in the U.S. here shortly. I mean, it's already starting, but we've got to actually hold the voting in the not-too-distant future, and it's not clear how we do that. A lot of places, a lot of states that began opening up from the lockdown are seeing spiking rates of new cases of coronavirus. So it's not clear that we're home free on the pandemic front. And, the political fallout of the civil unrest is leading to a lot of proposals that may or may not make it easier to run the government, and may definitely not make it easier in some cases. So, none of this is over yet, and we may not have seen the last big problem. And that makes it, very difficult to predict anything about the future, because, we're doing this interview on a day when the U.S. stock market just dropped by one of its biggest numbers ever, for no real apparent reason. It was just yesterday the Fed came out and said some things that weren't exactly what the market wanted to hear. They weren't aggressively negative or anything. They just weren't the, we'll take care of everything, don't you worry, we're going to push financial prices up forever kind of thing that the stock market really needs to go up because there's no other reason for it to go up. And it just crashed. So we're not in control of our fate right now. We're actually, we are in control if we make the right decisions, but we don't know what the right decisions are. So that's where we are right now. It's a very scary time coming on top of a time which, even without these specific problems, would have been very scary just for financial reasons. So we've got a really, really stressful period ahead of us, which is yet another reason to be investing in gold and silver, because those are the lowest stress assets that there are. You can look back 3,000 years and see that those things held their value pretty well through all kinds of crises and over incredibly long periods of time. So you got a pretty good chance of at least preserving your purchasing power and your nest egg if you do that. So, all roads seem to lead back to safe haven assets these days.
We'll have more with John Rubino when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with John Rubino. John, can we expect a parabolic spike towards the end of a bull market?
In stock prices?
Yes.
It's hard to say what to expect now, because we are at record valuation levels by some measures. There's a thing called the Buffett indicator, which is called that because it's the uber investor Warren Buffett's favorite indicator, and that is equity market caps in the aggregate compared to GDP. In other words, how valuable are stocks relative to the overall economy? And they are now at record high levels. In other words, stocks are as expensive as they've ever been relative to the size of the U.S. economy. And at the same time, the U.S. stock market is being supported by just like 5 or 6 big tech stocks. If you take them out of the S&P 500, the S&P 500 is actually down for the year. So it's very precarious. And you would, just looking at the numbers and the distribution of market caps, you would say that we're ready for a crash right now. However, the central banks of the world are back in QE mode, and a lot of them are kind of tiptoeing into buying equities right now. So it's possible that a year from now, we'll see all the major central banks out there just buying the components of the big stock indexes randomly or indiscriminately. In other words, they aren't going to be looking at, this PE ratio is relatively attractive compared to this one, and look at this dividend yield, we've got to buy more. They're not going to do anything like that. What they're going to do is just buy the components of these indexes across the board with newly created money, of which they have an infinite amount. So it's possible that means that stock prices can go way higher from here, just because we've got the ultimate dumb money now pouring into the market. And that gives you mentioned a parabolic spike at the end of a cycle. It's usually the dumb money that does that. And now we've got another source of dumb money that's bigger than any previous sources of dumb money have been. So it's hard to say what the impact of that is. So I wish I could tell you, the stock market is going to go up or it's going to go down. But there are good reasons for the stock market to do one or both of those things, at any given time. We could see a crash. We could see a spike. There's no way to know. And that's not good news. The world shouldn't work that way. The governments of the world shouldn't control the financial markets in a way that makes valuation no longer a valid indicator of the future. Because that means the price signaling mechanism of the stock market, which is really its function, it's there to tell entrepreneurs how to allocate capital. And that doesn't work anymore. So nobody knows what to do, and they're all flying blind. And the end result of something like that has got to be a gigantic crisis.
When you're in that kind of a situation, is there a particular investment strategy you should have, and any strategies that you should avoid like the plague?
Well, I would say this kind of uncertainty it implies that you should be diversifying, because you can't know exactly what asset class is going to do what, and you should be very cautious. So you should be diversifying within the universe of safe haven assets. And that will help you avoid losses. But at the same time, you have to recognize that if you don't buy Google right now and it doubles, you're going to feel like you passed up some easy money, and it could easily happen that way. But you could also lose 80% of your money in a normal stock portfolio. And I would say that the possibility of that kind of a risk is something you should value above the possibility of another doubling in your stock portfolio. So I think you should pay more attention to the risks in this market and respond to those risks by owning safe haven assets, real assets, things governments can't make more of, and do that with the intention of weathering this storm, not trying to get rich, because, these markets will create a lot of rich people, but they'll also wipe out a lot of people, and you have no idea which one you're going to be with anything that you do outside of the realm of real assets. So, gold, silver, farmland, well-chosen rental properties, maybe some well-chosen energy assets, things like that are vastly safer and therefore vastly more likely to protect your purchasing power going forward than tech stocks or growth stocks or even, value stocks right now. It's just, it's not a world in which you can say anything with certainty about equities.
There's something like $10 trillion in quantitative easing of some kind taking place right now. Where's that money going? Who's getting it?
Well, the way quantitative easing works is that a central bank well, at least in the case of the Fed, the central bank gives a bunch of money to the big banks. They, in turn, give a bunch of that money to their preferred customers. In other words, the 1%, the richest guys that bank with J.P. Morgan Chase or Citigroup or Goldman Sachs. So those guys get to use the money first while it's at its most valuable, before the increasing supply makes the value of the currency go down. And right now what they're doing is putting it into financial assets. They're buying stocks and bonds primarily, which is part of why the stock market is going up and why bond markets are still ridiculously highly valued. In other words, why bond yields are ridiculously low. So, that gets back to what I was talking about with dumb money before. It's not the central banks buying directly, in this case yet, but it is the central banks creating a bunch of money and giving it to people who tend to buy financial assets. Although, you're seeing some of that money bleed over into things like precious metals, since gold is going up and silver is starting to go up. So it's not a 100% dollar for dollar match where the Fed creates a dollar via QE and some rich guy ends up spending that dollar on Google stock or Netflix or whatever. Some of that money is flowing into precious metals, but the vast majority of it is still flowing into financial assets. So you don't want to do that if you're working with money that you can't afford to lose. If you can't lose what you're investing, then you want to be in real assets, and you want to be diversified within the universe of real assets. Don't load up on any one. No matter what I tell you about silver going through the roof, don't bet the farm on silver. Spread it around within the universe of real things, and you'll be okay. You'll probably be just fine going forward.
Can a healthy stock market translate into a healthy economy?
Well, the stock market is not the economy. It kind of used to be a barometer of the health of the private sector, but because of all the financial distortions that we've talked about, stocks now are just a barometer of how much money the Fed is creating and pumping into the system. That's all. It doesn't have anything to do with the real economy. That's how you can have us in one of the steepest downturns in the history of economic measurements, at the same time that stocks are at near record highs, right? You wouldn't normally have those two things occur together if stocks actually measured the welfare of the real economy. So, no, stocks can't cause the economy to do anything, but they used to at least give you information about what was going on in the economy. They don't even do that anymore. So now they're just yet another game in the casino. There's derivatives, and now there's stocks where the big banks just basically gamble for their own accounts mostly, and nothing more comes of it. We're not enlightened by that process, and it's a shame because the stock market used to be a very useful thing. You could look at it and kind of sort of tell what was happening in the overall economy. Now you can't do that anymore.
John, before we go, can you tell us a little bit about dollarcollapse.com?
Well, that's a website that I run that is basically a blog/news aggregation site that covers the stuff we just talked about. It's very precious metals oriented and basically is the chronicle of the ongoing financial crisis that is going to lead to a gigantic currency crisis somewhere in the future. So the idea is, show up in the morning, spend an hour there, and you're kind of up to speed on the dark side of the financial world.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and John Rubino. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm chatting with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, an exciting news release earlier in the week.
Yeah, it's probably one of the best news releases we've had in a long time. And what I mean by that is we've pushed the pilot plant, and we got up to from 64 kilograms to 160 kilograms per day. And what does that tell you? Well, it looks like maybe the 3-ton-a-day plant could turn into a 6-ton-a-day plant at the same cost to build as the 3-ton-a-day plant, which would return the capital a lot sooner. And that's really solid. I mean, that's solid work. We're continuing to do work on that. We might be able to take it up to actually where it's almost commercial testing, and then we can get on with the design and everything else. Now, I know certain people out there are impatient with the progress, but it's all been solid. And as you can see from this last bit of work, that this could, double the size of our proposed plant and reduce the costs of processing. So that's terrific. I mean, if that's not good, I don't know what isn't. Anyway, we're real happy with those results. It takes us on to a new level. And, we're competing out there with all kinds of guys that say they're recycling, but they're almost 100% black mass recycling, creating the black mass. Our contacts in the industry show that there's less and less places to ship that to, and there's a lot of competition. In Europe, there's got to be at least a dozen different black mass producers, and around the world, there's probably 25 to 30. So it's really important that we nail down everything we can about our process, because at the end of the day, where the companies will go to when they're forced to actually do something positive with the spent batteries, and they'll end up at our doorstep. That's what we want. That's why we spent our time and money on this. Now, we're getting closer and closer to where we can start to look at the detailed engineering and design on a pilot plant, but we want to have it, at maximum size before we do that. And I think maybe we could have reached the maximum size now, but maybe not. There's a few things that Cometco want to do that will also cost us more money. But the fact of the matter is, if we could go up another 50%, or even 20 to 50% on the size at the same cost, it's well worth doing. So, for those that do their due diligence on the bull boards, we're not exactly sleeping at the wheel, and what we're doing is important. This is a new technology, and believe me, it's a new way of advancing and financing that sort of an aspect. Although we've been talking to groups about financing, and we feel very positive on that note. So whether it's going to be a battery manufacturer or not, I don't know. They're interested in the manufacture of batteries, and who knows where the responsibility for recycling is going to end up. But from my sources, it'll probably end up with the EV car manufacturer. So it's a different kind of a scenario out there. This is not a mining property. This is not something that that we can cookie cutter. This is something that we have to invent every step of the way. And I'm sorry that some people feel impatient with it. If we had moved a lot faster, we'd probably be halfway through a design on a plant that was already obsolete. Not obsolete in the best part of the word, but obsolete on efficiency. And efficiency being lowering the cost and increasing the throughput. So, I'm really happy with the results. We go on and on and on about recycling, and there's all kinds of people that send me press releases from companies that are going to recycle, and we find out that even the big ones are just burning up some money they got as grants, and are not really have a process or near having a process. There's companies out there that have been working on recycling for a lot longer than we have, 3 to 4 times as long as we have, and they're still not at the point of excellence that we are. And I just feel and felt all the way along that once our process was proven to work, that we had the I guess you'd call it the golden fleece, and the Midas touch for recycling, and that's I'm still every day, everything that goes on, I'm feeling stronger and stronger in that regard. And I just want to encourage the shareholders that sometimes that you have to ride the tide and wait for results. They're not something you can generate on a computer. These are results that are through hard R&D, and we've certainly progressed the plant from almost monthly. We progress the results from our plant. We have worked with the Tier 1 companies. For anybody that's interested, some of that work will continue. And but are they looking for a solution, or are they looking for a solution for themselves? They're not forthcoming with that. People are not seeing the economic opportunity, except a few, and we're closer to actually getting this thing done with the companies that are not necessarily involved in the battery business. But it's an exciting arena. We've certainly shown our powder, which I have not seen any other company do. And, and I hope that we have a heap of powder here at the end of this session. So we just continue on, Jim. We continue on doing what we and Cametco do best, and that is proving up and increasing the value of our patents. And, it's all patented. It's not like it's anything different. It's a different methodology of moving ahead, and maybe a change out of some parts and everything else that allows you to increase the volume that goes through and still retain the integrity of the cathode metals. So it's raining here again, and it looks like another weekend of lockdown, and we just hope that I see a lot more people are getting out, a lot less masks around, and maybe we're seeing the end of this thing. And I can't end this conversation without talking about the Dow, which collapsed here a couple of days ago, and looked like it was going to, level out maybe today, but I'm not sure. Wait till the end of the day. But that run-up was long overdue for a correction, and I don't think that's the end of a bull market. I think that's a correction that's healthy for a bull market. And as I said before, the millennials or the Robin Hood group that are muscling the market, will be back in play here pretty quickly, and you'll start to see the Dow regain its losses and go to newer highs. So that's my take on the market, and I just wish everybody a fantastic weekend, and I'll get back to work. We've had about 3 or 4 different conference calls this morning, so the interest is there, and interest in all aspects of what we're doing, and we're talking to some pretty large companies out there, so something will happen soon, but I do believe that something will happen perhaps even this month. Okay, that's it, Jim.
Larry, for people new to American Manganese, what's the company all about? Where can they get more information, and where are you trading?
Well, Jim, the company's all about critical metals now, although we are looking at ways to capitalize on the fact that we do have high-grade gold and cobalt in one of our properties in central BC here, and I'm looking at ways that we can, capitalize on that. That may mean a spin-out to the existing shareholders of a new company. I don't know what the structure will be, but I do know that it's something that's high on my list of things to do. And, the aspect of the markets, certainly gold and cobalt are going to be in vogue. And we're not going to get the glitter off that unless we separate it out. So that's my plan, is to do that. I can't give dates or times or anything. Announcement will be made when that's ready to be done. And we have a website out there where you can get all the information you want on the company and do your due diligence, which it seems like few people do. And we are traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can go to our website at AmericanManganeseInc.com. You can contact me or one of the management groups at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 12th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of Howe Street Media Incorporated.